Radio for a really great future. We're talking real money.
Our job is to talk about your finances, your money every single day. Yeah, we kind of do that. That's why they call it Talking Real Money. We've been doing this for a long time. I'm your host, Tom Cock. Don McDonald has the day off. Roxy is here with me today. Roxy Butner, thank you. One of our advisors at Appella Wealth and well known to our fellow podcasters. So those of you listening to the radio, who only listen to the radio, this is the first time you've heard her. So yeah, does a great job with our clients. And, well, actually, she was just nice enough to work on a Saturday. That's how you ended up. I didn't want to break that to you because I went through all the other 8 advisors like, no, I am never coming up. No, I'm kidding. So we're glad to have you here. So the topic du jour is always, I guarantee this, if I meet, and I think I am going to meet like 10 new people next week, the number one question will be, do I have enough money to retire? Yep. It always comes up. And the answer is generally, I really don't know because there's a lot that goes into it. So when I read these stories and I read these polls and I read this stuff like the magic number now is this number. Well, how in the world could anybody know? I don't know my magic number, by the way, either. And there isn't really a magic number because these things go up, they go down. There's all kinds of other factors about, well, the one I think is maybe most important, how much you're going to spend before knowing the magic. But, okay, there's a new poll out, done by Northwestern Mutual, where they polled Americans and people said, I need $1.26 million to be confident in my retirement. And that was a decrease from 1.46 million a year before. So either people lost a lot of money in 2024 or something. No. Or I guess one of the reasons they felt better about having less was inflation has decreased. But I bet this was taken before the market fluctuations here in April, which probably thought, I better have a lot more money than that because the market's taken away. Nobody knows this. Yeah. It's a fascinating thing. It's fascinating to ask people about it. But the reality is there is no magic number. No. I think if you're over age 50, you got to have a plan. And most people should probably have a professional review because you should have somebody like you that does that. But what's your take? You read this stuff and you actually came up with this story. So maybe you're the one, obsessing over it or something. What do I know?
I am. I hate these magic numbers. And it's because really in my practice, I see folks who have, honestly, they could have 600,000 and that is their magic number and they're going to be totally fine. They have a great plan and you could have over 3 million and that might not meet all your goals. So it's so variable and you really have to look at all the different factors. I mean, at the end of the day, how much you need, it's 100% a cash flow equation. So it's, your retirement income, you've got your Social Security. Do you have pensions? Do you have rental property income? Other factors like that. And then your expenses, as you mentioned, is a huge one. I mean, there are people who are very comfortable with $70,000 a year.
Oh, I'd call my wife, would you? Let's be very comfortable on $70,000 a year. What do you say?
And of course, it depends on where you live, right, in the country, because I have clients who are over in the Midwest, and that might be really comfortable for them. But then you have others who maybe they're spending $200,000 plus per year. So that's obviously a huge difference in terms of what they'll need. But also the major expenses that you don't really plan for should be included in your plan and will affect this magic number. Things like, do you want to buy a new home in a different area? Do you want to have a fancy new car every 5 to 10 years? Also, do you have long-term care insurance? Because if you don't, maybe you want to self-fund a little bit and leave some money aside for that. So it's really impossible to tell anyone what a magic number is until you actually dive into their numbers. Yeah. Now, okay.
And by the way, speaking of magic numbers, I don't know if I gave ours, 855-935-8255. The show is about you. So we want to hear from you. 855-935-TALK. It doesn't have to be about your magic number. It can be about anything financial. But it's fascinating because even though the total number is less, only half, or about 51% in this Northwest Mutual poll, expect that their plan will work. Yeah. Which is sad because it's horrible to get to the end of your working years and say, I did all this. And I just talked to somebody, by the way, who is still working at 77, trying to support their grandkids. I was like, you got to tell your grandkids, sorry, I'm 77. I'm going to take care of myself now. Yeah. So we can touch up more on this, but we'd love to hear from you. 855-935-8255. And you get to talk to Roxy. You can talk to her directly. I'll just walk out of the room and go have a glass of water or something. So join the program, Talking Real Money. We will return in just a moment.
Tom and Don are talking real money. Tom and Don are talking real money.
Hey, welcome back to the program. Here to answer your questions and calls. Always the top priority, 855-935-8255. That's 855-935-TALK. Talking with Roxy Butner, one of our advisors here at Appella Wealth, and she's been on the podcast many times. Glad to have her on the radio show. Talking, before we get to the phones, just a little bit more about this Northwest Mutual study. Here's some, you read these numbers, you just think, wait, were they paying attention? 54% of workers who are not yet retired said they expected to be financially ready. That's after 51% said they expected to outlive their savings. That doesn't make sense, but it gets worse. 2/3 or 67% of Americans in their planning years feel confident about their prospects. That's down 7% from the year before. Now, the year before we had an up stock market, so you think you'd be more confident, not less. I don't know. This stuff's all over the place.
Yeah.
But when you read this stuff and you talk to people every day, what's your takeaway?
I mean, kind of going back to that other question that we got earlier about, what rate of return should we be using? There's really no good way to have faith in your financial plan unless you do run really a Monte Carlo analysis, the best way we know how to do it. So that looks at everything, what type of assets you have. Because, by the way, your magic number, if it's all in Roth, might look a lot different than your magic number. If
Good point. That's something we didn't touch on. You got to be invested correctly every day, and you got to know what kind of take the money taken out.
Yeah.
Because everything you have in pre-tax, guess what? It's only 75% of what you think.
Yeah.
Because you got this partner called the federal government that's going to come knocking and want their 25% or so.
Yeah. And then if you try and use a, general rule of thumb, like the 4% draw rate, you might realize when you do an actual plan and run 1,000 scenarios, you could have a much variable draw rate. You could be pulling 6-7% in the first few years, and then it might drop down later, and that could still work. So I think the only way to improve this score here, the 2/3 of people being confident in their plan, is to really have a robust Monte Carlo analysis to give you all the possible outcomes so you can solve for worst case scenario. By the way, if you're solving for worst case scenario, you have to have confidence.
Yeah. I mean, that would be another part of all this, frankly, is, and I mentioned at the top, the spending rate. When we look at the spend, we take today's spend. In other words, we don't just say you're only going to spend 90% of what you're spending while you're working, or 70, because I think that's baloney. People get used to what how much they're going to pay for, and they get used to going out to dinner and blah, blah, blah. And frankly, when you're retired, guess what? The one thing you do have more of is time, which means you could spend money, because I spend less of it because I'm working. So it's likely I'll go, wait, that would be really nice to have that thing over there. So
the biggest thing I'd say is that 5 years before retirement, you should really be dialing in on what you're actually spending. And that's not just your your basic monthly bills that are recurring. It's make sure you're looking at what you're bringing in, what's getting put aside, what's getting paid in taxes, and whatever you're left with, that's what you're spending.
Thank you. Very well put. So, okay, let's go back to the phones at 855-935-8255. We head to the great state of New York, where Scott is standing by. Hi, Scott.
Hi, Tom and Roxy. Thank you for the chance to call.
Absolutely.
My question is my wife's 401k, the employer puts the company match into company stock. And I'm looking to get your thoughts on if we should, if we should let that ride, or if we should sell it and buy the Vanguard 2055 retirement fund, target fund that she's currently in. It currently is around 8% of the total portfolio.
Yeah, so this is a very interesting point of discussion. My right off the bat answer would be sell that and buy the target date fund. And I'll tell you why, because we discussed this recently. Number one, people have an affinity. I work for this company. I know this company. I know it better than you do because I know the boss. I know the people. I know the product, et cetera. That's one. Number two, you take a ton more risk in an individual stock. There's going to be a lot more volatility. With the expected gain would not be any greater than the index it's a member of. This is work done by Fama and French and others that have found really the return of an individual stock, Microsoft, Meta, whatever, the expected return of that stock is the S&P 500, the index of which it's a member. Third part of all this is the part that dismays me the most. I've seen this up close and personal. I had 3 good friends that all worked for the largest trust bank in America in 2008. It was called Washington Mutual. And they kept telling me right up to the end, somebody's going to rescue us. We got a plan. It'll happen. And then it didn't. They had most of their 401k. I know your wife's less than 10%, but they had most of their 401k in company stock. But even if I had 10%, I'd feel risky, because if that 10% goes, what impact does that have on my overall situation? And the expectation is not you're going to make more money by being an individual stock, just you're going to have greater volatility. Roxy?
Yeah, I mean, I would absolutely. The second you have a chance, maybe they might set, I don't know, they might set some guideline. You have to wait X amount of months or something. But the second you have a chance to sell it and get it into the target date fund, I think that's great. I just looked it up. It looks like it's about 90% stocks, 10% bonds, that target date fund. So as long as that's appropriate for your guys' age and timeline, then I think that's the right move.
Well, thank you very much. That was very helpful. So the way I see it, there's really not a middle ground. It's basically unload it as soon as you can.
I mean, you could keep, if you want to keep like we always say, if you want to have some individual stock exposure, less than maybe 3% of your overall portfolio. But any more than that would be too risky.
Yeah, I mean, you're taking a flyer, right? I mean, you're hoping that something, and okay, for full disclosure, I am invested in a privately held small company. Yeah, I have a little bit of my portfolio in that, and I have a plan at which time to divest it, and hopefully it works out. But if you looked at the rest of my portfolio, it's all in a globally diversified stock side and a little bit in bonds, and I don't mess with it, and I just don't trust companies one at a time, because we've just learned over the years that bad things can happen to a company. By the way, the longer you hold that stock, the riskier it is, because companies do have a period of time of which they operate. And we're not going to go through the whole list of companies that people thought would never go away, although I guess there still are 2 Sears stores. But companies like that were so big and so important and so awesome, and then one day they were an anachronism. So again, that would be the reason I would do it. It would be just that risk, and especially with almost 10% of the portfolio in there. Scott, thank you very much for your call. And you can jump into the conversation, too. Ask us whatever question you have, 855-935-8255. We see people regularly walk in the door with, fairly concentrated positions, and I don't think they quite understand the risk they're taking with that. And here in the Northwest, guess what? It's generally, I always laugh. Do you know where Microsoft actually started the company?
Not Redmond.
Not Redmond. A place called Albuquerque, New Mexico.
Oh, wow.
Yeah, which is known for a very famous TV show, and that's about it. But imagine if Microsoft had stayed in Albuquerque. Would you be a big investor in Microsoft here in the Seattle area? Probably not.
Yeah.
Or what if Boeing, what if Bill Boeing decided to put his plant in San Francisco instead of Seattle? Would you be a big Boeing? Probably not. Yeah. People have this belief because they're in the same, or Costco, same way. What if Costco set up originally, before Jim Senegal sort of moved things to the Northwest, I think they were in Southern California. So what if those places were there? You would not have that affinity. I can almost guarantee it. You would not have that belief in the firm. Hey, they're right up the road here in Redmond. So those are things to pay attention to when you're investing. And you really want to be, as I say, this is globally diversified. I don't have one belief in one company whatsoever. 855-935-8255. 855-935-TALK. Give us a ring. We'll be glad to talk with you.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Welcome back to Talking Real Money. Our telephone number, 855-935-8255. Thank you, Roxy, for coming in on a Saturday, not being home, taking care of your huge lawn. She has a new house with this rolling hills of lawn.
Yeah, it's about 5 by 7 feet.
Oh, okay.
Maybe.
Well, not rolling hills. But anyway, so you came in on a Saturday, and we do appreciate it. So Don's got the day off, but he will be back soon. And let's take some more of your questions and calls from Washington. John now joins us. Hi, John.
Hi there. How you doing?
We're doing great. How can we help you today?
Hey, so I'm 60 years old, and I already maxed out my 401k,
Terrific.
and I'm going to be getting a $20,000 bonus check from my employer. What do I do with that extra $20,000? I don't really want to just pay taxes on it and have it just go right into my, into my bank account.
Now, okay, remember, I think between ages 60 and 63, there's an additional 401k amount you can put in beyond the, not just the whatever it is, 23.5 and the catch up. I think there's another amount you can put in too, beyond all those, another like 6,000 or 7,000. So that's one thing if you haven't got the money already. In terms of getting the bonus, this is going to be regular income. Is that what you're talking about?
That's correct.
Yeah, I mean, I don't have any trick to sort of getting a bonus and not paying taxes on it. I don't know my way around that, but you could certainly. I mean, is your income in a place where you are eligible to have a Roth IRA?
Yes, it is.
Oh.
So you could take, 8,000 of that 20,000 and put it in a Roth. Now you still would have paid the tax, but then every bit of growth moving forward would be tax free.
Now, can I do a Roth in my name, and can my wife do a Roth in her name, and those be separate?
Yes.
Well, they have to be separate because they are individual retirement accounts, Roth IRA. And yes, you can do one for you and one for your spouse, both in the amount of $8,000 for tax year 2025. I have that right, don't I?
Mm-hmm. Yeah. If you're over age 50, which you are.
Okay.
That's
it.
16 grand. You take 4, give it to the government, and call it a day.
Yeah. The only
That sounds like a win.
Only caveat to remember is the 5-year rule. So you want to make sure you don't touch those funds for another 5 years. But if you have your 401k to live off later on in retirement, you're good to go.
It's 5 years on the Roth.
Correct.
Okay. Thank you very much.
You're most welcome. Thanks for calling us. Yeah. What is the 60 to 63 thing? I forget what it is. There's an additional number. They added this weird thing in like a year ago or something where they said for people, it's so strange, like 3 years.
Additional catch up.
Yeah, it's an additional catch up, but I forget the total. It's, I don't remember. You're looking it up. You're going to do this more quickly than I would. But I mean, that's another way that you could do that pre-tax then. See, that's what I was trying to get to. Yeah. But otherwise, you're simply going to take that bonus and then you're going to roll it into, or not roll it, but you're going to, make a contribution into your Roth for tax year 2025 for both you and your spouse. And then, as I said, moving forward, you're going to get tax-free growth. So the Roth is a wonderful invention.
Yeah,
so,
the enhanced catch-up looks like at that age is up to $10,000 or 150% of the standard age 50-plus catch-up contribution, which is the $7,500.
So is about 10,000
up to 10,000.
Yeah. So there's another way, John, you could he's
add
gone
a couple extra thousand.
You could throw a couple more at that pre-tax. I mean, this is something else to think about, though. In some cases, it might make sense just to pay that and then have Roth, because it's really nice in retirement to have different buckets, if you will, to draw on, to have the pre-tax, to have the Roth and the brokerage, because then when you get into the withdrawal section, or part of your life, you can design a most tax efficient method of drawing that money. So that's another reason to consider looking at all that. So, at any rate, those are the kind of things that advisors take care of every day, right? Isn't that what you're sitting around doing in that office, that fancy office you have down the hall here?
Absolutely.
Okay. I just wonder, because the doors always get closed and everybody comes in. I never see anybody, and then it's like, what are they doing?
True.
What are they doing back there?
There's plenty of people here.
Okay. Now, I didn't say they weren't here. I just said they weren't talking to me. That's all. But you can talk to me. 855. I feel sorry for myself. 855-935-8255 is our telephone number as we continue talking real money. We'll be right back.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Thanks for being part of Talking Real Money. Our job is to be here all the time, answering your questions. We do this show every Saturday. We do 5 podcasts a week. And beyond that, we talk to many of you one-on-one to make sure you're doing everything you can for yourself to put yourself in a better financial position. So happy to take your call. Still lots of time. And let's work Roxy. We made her come in on Saturday. Let's work her hard while she's here by calling 855-935-TALK. That's 855-935-8255. You're probably thinking I'm kidding. I'm not kidding.
I know.
I want people to work hard if they're here.
That's good.
Pay attention, work like, anyway, you know the rules. Let's go back to the phones. Sam calls us from Seattle. Hi, Sam.
Hi, how are you?
Doing great. How can we help you today?
I was reading an article, and they did not get into detail, different ways to ease the pain of taking an RMD. And I have good problems as far as I don't have to worry. But they were talking about long-term care and home improvements. And I assume they were talking tax things. Is there any validity? They did not get into detail.
Yeah, I'm going to say no, because the only one I know where you can relieve the burden of required minimum distributions, which now for people getting into that range start at 73, they're going to get pushed back to people at age 75 if you're born in the year 1960 or later. The only one I know are qualified charitable distributions, where money goes directly from the IRA to the charity, which relieves you of paying the tax on that distribution. Roxy?
I think
I do.
I think you can do a small amount towards just the long-term care premiums, from what I'm seeing. But that's still going to be a taxable event, right? That's a good question.
I don't think that avoids. You're still going to pay tax on that money that's moving over.
Okay, so that, like I say, they did not get into detail, but they talked about long-term care and they talked home improvement. And I'm going, what the heck? But there was no.
Think that through. I mean, that doesn't make sense, right? Why would the government, just because you're going to put a new deck on, allow you? Now they may they may allow you to move money directly from your IRA to long-term care premium or something, but that doesn't really matter because you're still going to pay the tax on it. That's still taking income and then paying it out, but. No, as I say, the only one I know really that alleviates you is to give it away to a charity.
Maybe they were talking about deductions that you can take. Against it, which is a different conversation.
Completely.
If you're itemizing deductions, certain medical expenses, long-term care premiums would be part of that. Maybe that's what they were referring to.
Okay, no, I don't have any deductions is one of my problems, but I do QCDs. But I was just curious, that popped up on my laptop, and I was just curious. And I listen to you folks all the time, and I go by what you say.
Well, that's very kind. Thank you for that. But pay your taxes, dang it. Come on. No, give me a bad time.
Oh, that's the problem. I pay too much. That's
all right. Okay. That's very kind. Well, then you can call me about putting a deck on my place, and, I already have enough decks. Okay. So, no, thank you, Sam, for listening.
Thank you.
You bet. And required minimum distributions. This is another thing for young people. If you're really just starting out and you're in your 20s and 30s, I think it makes a ton of sense. We can ask you, what's your part Roth and your part post?
100% Roth.
Yeah.
And I've actually ran my own plan a few different ways, do 100% pre-tax.
We won't tell people how old you are, but you're young, so we'll leave it at that.
50, and every single time it says doing the max that you can to Roth works better because
in terms of where you'll be down the road.
Exactly.
Yeah. I would favor the government getting rid of all pre-tax stuff. You've heard me say this before because it's confusing.
Complicates
government
things.
says they're going to need more money, blah, blah, blah. And then you're going to get it right now. And then your money's going to go in there, post-tax. And then it's going to grow post-tax. You can take it out tax-free. So I think for anybody who's young, who's really starting out, huge advantage to doing it all Roth.
Some people are they don't care. They don't know what the future holds and they want to pay less taxes today.
Yeah, I get that.
And some people are like that, but I'd rather take the hit now and have peace of mind later.
You're going to be in a great place. And then you got that huge lawn to look forward to luxuriate out on.
Hopefully it'll be a bigger lawn.
Oh, okay. I see you're going to double down on the lawn thing. All right, let's go back to the phones at 855-935-8255. Barbara joins us from beautiful Gig Harbor. Well, actually, we're going to take a break, Barbara. We'll come back and talk to you in just a moment here. My bad. I hear the music playing. That means time for Tom to exit. And we'll be returning here as we continue talking real money.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Talking Real Money wants to help you by doing this podcast, by doing our webinar stuff, which is all up online. You can go to YouTube, by the way, and now see Retire Meet 2025, and you were in there. Mm-hmm. I think I saw you up on the stage.
Yeah, it was
you
great.
Shoved me out of the way and said, "I got it from here, old man." That was great. Good for you. That's so brave. So brave.
But it was fun.
It was good. So you can go, I think you go to YouTube and type in Retire Meet 2025, and it all pops up there. You can watch all those things absolutely 100% free now.
Yeah.
Yeah, pretty good deal. So learn, baby, learn. Let's go back to the telephones at 855-935-8255. Now, Barbara, I apologize for inviting you in earlier when I blew it, but here you are, and welcome from Gig Harbor. How are you?
I'm great. Thank you so much for taking the call. I've talked with you once before, a while back, about HRAs, and I got a notice in late 2024 that the company was changing from Metropolitan West Total Bond to Fidelity Total Bond, K6. I'm wondering what you think about that. And also, I'm at a 60-40 split with regard to stocks and bonds.
Okay, so you said HR. Did you mean
or leave it?
HSA?
Health reimbursement account.
Oh, health reimbursement account. Okay, which I'm less familiar with, but Correct. Do you know much about these, Roxy? So,
it looks like it's just employer funded.
Yeah. So
medical.
This is something that later you can draw out, pay your bills, and don't pay any taxes on. I'm believing, correct?
Correct.
Yeah.
Correct.
And what you're talking about is they're changing one of the funds you could invest in. Your options are either, you said, the Fidelity Total Bond.
That's the one they went to. Fidelity Total Bond K6.
Yep. That just refers to the share class.
Right.
And what was it before that?
Metropolitan West Total Return Bond.
Yeah, my guess is, and I could probably, I guess, let's just do it, but the total bond from Fidelity is 0.44. It's relatively cheap. The Metropolitan West Fund, which sounds like it holds a similar type of portfolio, but it's actively managed. Mm-hmm. And Roxy's faster than me at this. West Bond.
That one is 0.66.
0.66. So that's about a third more.
And actually the Fidelity Bond Fund K6 share is
A6, I think she said.
Is it K6 or A6?
K like king.
Oh, pardon me. I was wrong again.
So
I'm getting out of here, Roxy. You just take it from here. No, it's all right.
It's 0.3, so it's even lower. So it's basically half the price.
Yeah. So no, we think this is a good move by the company to get a cheaper bond fund. And yes, these are very similar products. They hold a basket of bonds. They're diversified. And the idea here is this is the stable part of your portfolio. So no, I'm not unhappy with that move at all.
And is 60-40 split still safer? I know it's
safe. Now you got to be careful when you start throwing those kind of labels out there. Safe.
Oh, okay.
Yeah, because the thing about when you say safe to me, I think a bank account, high yield savings CD, because there's no movement of the principal, right? It's there every day. Stocks and bonds go up, they go down, bonds less than stocks. But do I think a 60-40 is a balanced portfolio? Yeah. And by the way, despite all the publicity and the wrangling and gnashing of teeth, year to date, it's about flat after all of the action here that we've had this last weird and wacky month of April. So I think it's a good portfolio, but here's the thing we don't know, Barbara. We don't know anything about your tolerance for risk. We don't know how much risk you need to take in your portfolio. And we don't know what your overall plan is and how much return you need to sort of take care of yourself in retirement. So for me to just assign a 60-40, I'd be a lousy planner, but I'll make Roxy do it. What do you think, Roxy?
I mean, I agree. I would say for a lot of retirees, if you've done some accurate planning and have a good, conservative draw rate, 60-40 should be fine, but it's hard to tell you exactly if that's the right allocation for you.
I see. Okay, well, that was question number one regarding my HRA. The second question I had was probably geared more towards Roxy, not on my behalf, but possibly on my behalf as well. I'm encouraging my daughter to seek out conversation or information with you guys. And I have been listening for a long time. And I know that Roxy has been with you and from, the last several years anyway. And so I'm wondering, I know she has to take that test and everything. And when it says call for an advisor, can she put your name in directly, or how does that work?
Yeah, absolutely. You just go to talkingrealmoney.com, click on meet an advisor, and then the contact form say, like to talk to Roxy.
Yeah. Love having conversations with young investors.
And
where's
Roxy,
the line, by the way,
question.
just so I know? Go ahead. Sorry, I was teasing her. Yeah, go ahead, Barbara.
Oh, one more thing, Roxy, that I was curious about. This is just because I'm a mom, but do you when you talk with someone, I think she's kind of looking for someone to help her kind of figure out how to better manage, like, just her money, like her paycheck money and all that kind of stuff.
Yeah.
And do you do that sort of thing, or is it strictly just regarding investments?
No, I go into every conversation very open-ended, and if that's what's important and what that person needs to focus on, then that's what we'll focus on, and I'll give her some great advice and send her on her way.
Awesome.
Wait, you want someone to come in and tell your daughter to spend less money? Is that what I'm getting out of all this? I'm just.
She's a daughter, what can I say? I've been trying, I've been teaching, I've been working, I've been showing. But, kids and their parents sometimes just, it goes in one ear and out the other. But
absolutely.
Sometimes you got to hear it from...
Yep.
Yeah, sometimes you got to hear it from a third party.
And I love Tom and Don. I listen to you all the time. And I was so happy to hear your voice today, or knowing that you were going to be on the show, Roxy. I just had to call in, and it'll just encourage me to get in touch with you right now. I mean, my daughter.
You. Thanks for listening.
Yeah, thank you. And by the way, if you can get... No, our pleasure, Barbara. Thank you for being on the program. This is the part that's fascinating from a psychology standpoint. Most people, we find, don't really start thinking about this till they're in their 40s or 50s. I'll get around to that, The reality is, if you do it at 20... only until you're like 30?
Yeah.
And then let the money just compound?
It's crazy.
You're going to be in a good spot. So it's a fascinating thing. If you can just figure out the first part, which half of America doesn't do, which is save something.
Yeah.
And then the other part that I feel like is getting easier, but is more confusing because of all the messages, invest that and leave it. And don't care about the tariffs or interest rates or politics or all the other stuff that's going to come at you, which it will. Wow. I mean, it's so powerful. I've tried to do this with my children. It's not perfect, but, my youngest, by the way, takes it very much to heart. And, she's had a Roth IRA for like 4 years. She's 17. Now she has a good income because she works, and we're piling money. I mean, I'll be gone, but she'll be thanking me because it's going to make a huge difference. So yes, we love to talk to young people. We can do it quickly around spending, saving, and investing, because it's not that complicated when you're in your 20s and early 30s.
Yep.
It really isn't. So thank you, Roxy. That was a nice compliment, too, by the way. So
really
it made the
nice
whole
of
trip
her.
worthwhile.
Absolutely.
So there you go. Yeah. All right. We'll be right back with more as we continue talking real money.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hey, thanks for being part of the program. And for those of you who didn't get your questions answered today, again, we answer them all the time. You can go to talkingrealmoney.com, click on Contact Us. You can do an audio question that Don will have on his podcast, the written ones, which we didn't get to a lot of them because we had so many great calls. But we're here. And yes, people talk to you every day, don't they? I mean, about their money. It's a fascinating thing. So what part of the job do you like the most?
Honestly, getting to be a part of people's lives. That's really
I think I've said that people don't realize how it's rewarding.
Yeah.
And it's not just to learn, but then to be able to say, go do this, this, and this, and they actually do it.
Yeah, it's
kind of cool.
You really start to feel like a little bit of their team, and that's a really fun feeling.
Yeah. So take advantage of all that. Again, and we do the portfolio analysis. I do want to mention that if you're in the Southwest Washington, Northwest Oregon area, I'm coming to Portland on the 21st. I still have one more appointment I'm going to do while I'm there in person. We'll do the whole analysis of your portfolio. Prior to that, sit down and talk about it, which is the part that we do free, where we look at, how diversified you are, how much risk you're taking, how much you're paying others. We lay it all out there for you and tell you here's how to do it better. But Portland on the 21st, any day here in the Seattle area or anywhere else in the country. And yes, we have clients in every one of the 50 states from this office in Bellevue that we take care of. Some people are okay with Zoom. Some people do phone calls. Some people come and see us. So take advantage of all of that stuff by simply going to talkingrealmoney.com and click on Meet an Advisor. Don't care how old you are. Don't care how much money you got, right? We talk to people every day that aren't Bill Gates style money, right?
Just happy to set people in the right direction, to be honest.
And you're enjoying your job still. You show up every day or almost every day, still doing it?
Apparently almost every day of the week now.
All right. Yes, I'm told that is another change that is coming our way. So, listen, if you'd like to ask a question for the program, people ask me this all the time. You can do this written if you don't really want to be on the program. You simply go to talkingrealmoney.com, click on Contact Us, and fill out the form. We get to most of the questions pretty regularly. We've had a good number lately, but simply fill out the form there or leave an audio question that Don will answer. And yeah, he'll be back next week. He's feeling better already from his little procedure at the end of last week. So please take advantage of all those things. Get the help you need. Yes, we manage money for a living. And we build the portfolios, we do the planning, we do the RMD, all that stuff that, seems for many people it's just too much work.
Yeah, absolutely. I mean, you want someone on your team who's going to be able to take that stuff off your plate, especially as you really start to go into retirement so that you can, go fishing or go travel and see your grandkids or whatever it is that's important to you.
Absolutely. So again, all of those wonderful things at our website. And for those of you who've never been to the website, there's a lot more stuff there, too. There's all kinds of educational videos. There are all kinds of podcasts if you prefer to listen to them from there instead of going to Apple or Spotify or one of those other places.
Great articles written by our
advisors. That's a good point. We're working hard on all that kind of stuff to make you smarter about money, about estate planning, about all the topics related to retirement and investing. So take advantage of all that stuff. I hope you will tell your friends, too, about our podcast, which is, I think, generally pretty entertaining and helpful and educational. The idea there is we're going to make you a better investor, a better saver, and a person that puts money kind of where it deserves, not at the top of your list. So all of those goodies there all the time because, as you know, we continue talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?